Hi guys, Ben here and welcome to Motivation to Invest. Now we've all heard of the prestigious FANG stocks. That's Facebook, Apple, Amazon, Netflix and Google. And although these are exceptional companies and I have many of them in my portfolio, due to so many eyes being on them, they are often overvalued. So in this video I'm going to do a quick fire review of the FANG stocks before revealing my top 6 tech stocks which you've probably never heard of, but they've actually outperformed the amazing FANGs. Now this may sound like science fiction, but believe me, it's true fact. So if you've got your tech head on, let's get ready and dive in.
Coming in, Flex, I just wanna win.
Welcome back guys to Motivation to Invest. Before we get started, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investing tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Be sure to turn the notification bell on. That way you'll get notified when I release future stock picks. With that being said, let's get into the video. Now before I get into my top 6 tech stocks, let's do a quick fire review of the FANGs. Apple was actually the best performing FANG stock of 2019, thanks to its service business momentum, which offset iPhone related weaknesses. The company expanded its portfolio of products with the new Apple Watch Series 5, streaming service Apple TV Plus, and of course Apple's AirPods, which silenced the doubters who didn't think Apple still had those unique design skills. As we entered 2020, Amazon took the throne as we saw an increasing number of users shopping online. Over $11,000 a second is spent on Amazon's products and services. Despite the economy being in tatters, Amazon's share price surged by over a third and reached all-time highs. This has further cemented Jeff Bezos' position as the richest man in the world, with an estimated fortune over $138 billion. But that's not all. While most companies have been firing workers, Amazon has been hiring. The company actually hired over 175,000 workers in the US alone. Facebook has also seen its share price reach all-time highs, shaking off privacy and data concerns of 2019. No doubt though, these will resurface during the 2020 election campaign. Just recently, Facebook has even announced state-controlled media pages. Then of course, we have Alphabet, the parent company of Google. This is one of my favorite stocks and a large portion of my portfolio. And during the 2020 crash, there's been many opportunities to buy this stock. Of course, Google has close to a monopoly on internet search, with nearly 90% of searches performed on the platform. This collection of big data is extremely powerful. Then of course you have the amazing Google Maps, G Drive, Gmail, Chromecast, Google Home, and even autonomous vehicle technology. Now I did a previous video analysing Google's stock, so I will leave that in the link below. Then finally we have Netflix, which is a great stock overall, but actually the worst performing FANG stock to date. This is due to increasing competition by Disney Plus and Apple. Now with the whole world having their eyes on the FANG stocks, it's no wonder that their valuations are extremely high. Now as the great investor Sir John Templeton says, observe the masses and do the opposite. And in the words of the great investor Peter Lynch, invest in overlooked companies. So now I'm going to reveal my top 6 tech stocks which have actually outperformed the prestigious FANGs. Coming at number 6 is Momo. Momo is China's answer to Tinder and is the #1 dating app in China. It's actually the 3rd largest fully mobile app after WeChat and QQ, with over 81 million monthly active users. Overall, Momo allows users to connect with strangers based upon interests and location. Apart from that, the company is trying to make the app more than just a dating site. By launching a campaign to help homeless cats and dogs in China, they are also offering mobile gaming and live streaming to improve the way users connect with each other on the app. So how does Momo make money? Targeted advertising, of course. So imagine you're organising a date with someone. They can see on your interests that you're into, say, horror films. They can also see the girls into the same thing, these horror films. So advertisers from a nearby cinema can target these users directly with offers from that local cinema. Now this is truly amazing targeted advertising. Right guys, so diving into the numbers, Momo looks like a very, very interesting stock. So we're over here on Stockopedia. This is a great platform I've been using recently. I highly recommend it. I've also got a link which will give you 25% off when you sign up. So if you're interested in Stockopedia, you want to check it out, there's a link below. But yeah, let's get into this stock, Momo. So from the stock rank here, which is specific to Stockopedia, they rank it based on momentum, value, and quality. So they said the stock has great quality, great value, momentum slightly lower. But that's only based on the last 30 days of trading, down -2. So, but overall it's got a stock rank of 86, which is pretty good. Basically the higher stock ranks have generally outperformed the market. So that's just something to be aware of. Looking at the share price, so you can see it's approximately $20 a share today, down from January highs of $34. It's quite high around 2018, approximately $40. So we'll see what happened there, why it sort of slid. But yeah, let's look at the numbers. So this is what really excites me about this stock. So the compounded annual growth rate has an average of 128%. Now, to put that in perspective, great growth companies usually grow at, say, 25%. That's very good growth. For example, a company such as Facebook, that aims for, say, 20% growth, and everyone would be extremely happy with that per year. Obviously, it's a lot bigger company, but still, 20% growth rate is amazing. But this has a growth rate of 128%. And that just shows you the power of social media and this world that we're living in. So the revenues, so as you can see here, 276 million back in 2014, increased to 842 2015, and it just kept going. And then it's expected to reach over 19 billion by 2021. That's the estimated. Operating profits also increasing steadily. Earnings per share, steady increase, which is all great to see. Operating margin, approximately 20 to 30%. But it has been increasing overall by but it has increased overall by 7%. Can't see any dividend details. Balance sheet. Now, balance sheet's a really interesting one with this stock. So they seem to have a lot of cash, which is great news, especially given the current climate. It's also low overheads. It's an app. It's not got any sort of properties and shops or like a retail store, for example. Book value. So yeah, looking at the revenue here, it's projected to increase. Net income's projected to increase. Earnings per share is projected to increase. And then this is what I really like. Usually when a company has such good fundamentals, such as this, it's got a high valuation. However, in this case, the PE ratio is just 8.3, which is very good. And the price to book value is just 2.35, sorry. Price to sales, 1.85. Current ratio, so that's how many times this company can cover its assets with its current cash. And that's 4.68. Now, to put that into perspective, a great current ratio is anything, I'd say, over 2 is a great current ratio. Means the company can pay its debts at least twice. This can pay it over 4 times, nearly 5 times. So, fantastic company. Analyst consensus, 15 say a buy, 7 say a strong buy, and 2 say hold. So, to me, this stock seems like a pretty much a no-brainer to purchase. So let's look at the risks, because there are some risks with this stock still. So the first risk is the Chinese government. So back in 2014, China's state-backed media slammed Momo as a hormone-filled app which was used for prostitution. Now, that was a long time ago, and Momo weathered the storm. But China has been cracking down on hundreds of live video apps for offensive content. So that's just something to be aware of. Hopefully the Chinese government won't crack down on this app. Momo actually acquired another similar dating app called Tantan, which was temporarily booted from China's app stores last year due to allegations for inappropriate ads. And then you've got Tencent's WeChat and dating app. So WeChat is the top mobile messaging app in China with over 1.15 billion monthly active users. By comparison, Momo's core app only reached 114 million monthly active users. It's an ideal platform to forge social connections indirectly, and although it's not an official dating app, a lot of young people do use it in China. But that's not all. Tencent has also launched an anonymous video dating app called Mahu or Catcall, in which users have virtual masks while chatting. There is also another Tinder-like app called Qingliao Live Chat, and its Peggy You Friends app. Now, both Momo and Tantan both need to gain Gen Z users to keep growing, but many of these younger users are gravitating towards short video apps like ByteDance, TikTok, and Joys, which reach over 500 million and 100 million monthly active users worldwide. TikTok is the fourth most popular downloaded app worldwide, according to App Annie. Now, I've been onto TikTok. I understand the appeal of it, but to me, it's not really a dating app. Yeah, young people can be on it and they can chat on it and they can interact on it, but it's not a dating app. So I don't worry too much about TikTok, only in terms of where young people's attention will be pushed to. So for example, obviously TikTok is a popular app. If people are spending that much time on TikTok, they won't be on Momo. So that is the risk with this stock. But due to the numbers and the analyst estimates, I still think it's worth a small investment in my portfolio. Right, guys, so number 5 on the list is Diodes Incorporated, based in Plano, Texas. And you can find these at diodes.com. So diving into the numbers of this stock, we can see it currently has a stock rank of 93, which is incredible. Great momentum, great quality. Values average according to this stock screener, Stockopedia. So yeah, we've got, obviously it dipped during the crash and now the share price has started rising again. It's approximately $53 a share. It reached $57 January. Let's look over 5 years. Yeah, that was its peak. Peaked in January. There. Let's look at the numbers. So it says obviously its revenues have been rising, which is a great sign. Compounded annual growth rate 7%. Operating profit has been increasing though by nearly 20%, which is incredible. Net profit, earnings per share growth. Operating margin has been increasing by approximately 19% on average. So yeah, it says its forecasted revenue is predicted to stay pretty much the same. Slight drop in net income. Earnings per share, slight decrease. Current ratio 3, so this can cover its debts approximately 3 times. That means it's got a great balance sheet. Return on capital 13.6%. Return on equity 13.5%, both great numbers. P ratio 21.7, slightly high really, to be honest. That's the issue with this stock here. Let's dive into the executive summary. Earnings forecast growth 8.52% per year. Earnings grew by 20.8% over the past year. Yeah, so here you can see it's got a fantastic balance sheet. Lots of assets, much greater than its liabilities in the short term and the long term, which means it's in a healthy position. Now, okay, here's something interesting. There's been quite a bit of insider trading at $50 a share. Now, to me, that suggests that the people on the inside believe that this stock is overvalued, which was my initial gut reaction. So let's see who's been selling. Tu Xiu Lu, 1.275 million. Okay, so the CEO, president, and chairman of Diodes Incorporated has actually sold over $1 million worth of stock literally just last week. So to me, that says, and obviously look at all these other sales from people on the board, I'm assuming as well, all these sales here. That says to me that they believe that the share price is currently overvalued at its current state. So although I do believe this is a great company, I will be avoiding it for now until it drops to a more reasonable value. As you can see from the discounted cash flow calculation, it says it's 12.4% overvalued, which isn't massively overvalued, but it's still overvalued. Coming at number 4 is Amkor Technology, another company in the electronics industry. Amkor Technology is one of the largest providers of semiconductor packaging and testing. We all know electronics is ubiquitous and in every corner of our life, and this is only going to increase in the future. And Amkor Technologies is one of the leading companies in this space. Right guys, so diving into the numbers here of Amkor Technology Incorporated. Now, according to this stock screener, Stockopedia, this has a stock rank of 99, which is pretty incredible. Momentum of 91, value of 82, quality of 94. So really it's ticking all the boxes. It's a great company at a great price. Just $12.55 a share. It dropped to a low of $5.78 a share. It's close to basically where it was just before the 2020 crash. So yeah, total revenue here, 5.31%. I'd call this company a slow grower, just looking at the revenue growth. So yeah, don't expect miracles from the company, but it's providing a reliable service to people, which they need. Operating profit, steady increase. So yeah, it says revenue is forecasted to increase by a slight amount there. Net income decrease. Earnings per share decrease. Now, interestingly, the analyst consensus, 2 say hold, 1 say sell, 1 say buy. So I'd say that's pretty inconclusive on the analyst consensus, which is interesting. Sales growth. Okay, this is interesting. 28.79%. Current ratio 2.06, which is pretty good. Means it's got a strong balance sheet. Price to book value 1.39. That's pretty decent. Price to tangible book value, price to sales, PE ratio. Says it's pretty good for the industry. Now, yeah, but it's got really good figures here. So let's check out the other details. So here it says earnings forecast to grow. Earnings grew by 120% over the past year. So that could be the interesting. Now, it is interesting. According to the discounted cash flow calculation, it says that the share price is 476.7% overvalued. Now, that's pretty incredible, really. This is its fair value is $2 a share. So that is an interesting one right there. Oh, interestingly, Winston Churchill actually sold $59,000 worth on the 24th of February. Winston Churchill. He's the lead independent director, apparently. Winston Churchill. There you go. We'll fight on the beaches and we'll invest in stocks. Coming at number 3 is Plexus, another electronic stock. This is a leading provider of electronic contract services. They work on electronic products through the entire cycle, from design and development to supply chain solutions, new product launches, manufacturing, and even aftermarket services. Right guys, so diving into Plexus here, we can see it's labelled as a super stock. According to Stockopedia, stock rank of 96, which is pretty decent. Momentum 89, value 67, quality 86. So overall it looks a great stock. $70 at the moment, which is the same as it was before the crash. Now, given the current economic conditions, I think this is a little bit optimistic. Looking at the revenue, 5.88% compounded annual growth rate. So yeah, I'd call this company a slow grower also, but a reliable slow grower. Operating profit, 7.14%. Now, having said that, it's a slow grower, but it's in a growing industry, shall I say. Net profit, 4.49%. Earnings per share increase. Operating margin increase. Right. So yeah, looking at the revenue here, revenue is forecast to be pretty much the same for 2020. 2021 increase. And yet similar with net income. Earnings per share, slight decrease, and then a massive increase. So analyst consensus, 2 say hold, 3 say buy, 1 say strong buy. So, and I'd say I do agree with that overall. Current ratio 1.77. So it's not as good as the other stocks that we've been seeing, but it's still pretty decent. As long as it's over, like close to 2, 1.5, then that's usually pretty good. In terms of the business, price to book value 2.29. That's quite good. Price to sales 0.63. That's very good. P ratio 18.3. So yeah, interesting stock. Let's look at the other details here. Trading at 2.2% below fair value. Earnings forecast to grow at 19.16% per year. So yeah, it's only 2% undervalued according to this discounted cash flow calculation. So yeah, I could do with it being a little bit cheaper, to be honest. And as an investor, give yourself a margin of safety when investing into this business. But it is quite a safe industry overall. So yeah, financial position analysis, great balance sheet, lots of assets compared to its liabilities. So in the biz, they call this the debt to asset ratio, and it's got obviously a great debt to asset ratio. Right, insider trading, here we go again. 29th of May, there's been some sell-off, so they also believe it was overvalued. But this was at $67 a share. 7th of May, $61 a share. So someone sold $500,000 worth. Angelina Nivagi, let's see who that is. She's not on here. Todd Kelsey, he's the president. So the president of the company actually sold nearly $200,000 worth of shares at $61. So today the shares are even higher. So I'd say great stock to keep your eye on, but yeah, a little bit overvalued given the current situation. Coming number 2 is Synaptics, based in San Jose, California. This is a really interesting company based in the human-machine interface space. They're involved in everything from simple touchpads for computers to biometric scanners. According to a recent study by Grandview Research, the biometrics technology market is likely to reach over $59 billion by 2025, experience a compounded annual growth rate of 19.5% during the forecasted period. Right guys, so diving into the numbers here for Synaptics Incorporated. So yeah, it's got a great stock rank of 89. Momentum's looking very, very good at 93. Quality's looking exceptional. Value, again, it's not great value. So $72 a share currently. Didn't really drop too much, up to $49. Before the, obviously, global crisis, is approximately $80 a share. Was at its peak. It's been very up and down, to be honest. Yeah, so yeah, I would agree in terms of valuation there. A little bit high, but yes, slow grower. 9.21% compounded annual growth rate. It's obviously over the past few years. Looks to be an increase, a decrease in revenue, for the prediction there. Operating profits. Yeah, so the revenue is predicted to decrease. Net income is projected to increase. Right, let's look at the analyst consensus. 1 say sell, 5 say hold, 4 buy, 1 strong buy. So you can make what you wish of that. Current ratio, great current ratio, strong balance sheet, 3.48. Cover its debts easily. Price to book value, 14.8 P ratio. So yeah, slightly high. Right, let's look at it on here. Earnings forecasted to grow at 31.15%. Yeah, slightly overvalued, 3.2% overvalued, but it's not a massive amount if you're a long-term investor. Coming at number 1 is CDW Corporation, a leading provider of integrated IT solutions for small, medium and large businesses. Its customers include government, education and healthcare across the USA, UK and Canada. Right guys, so diving into the numbers for CDW Corporation. So we can see it's a large cap high flyer, stock rank of 89, momentum down in the last 30 days, but still pretty high at 85. Quality, exceptional, 97. Value again, slightly high. Slightly low, shall I say, in terms of costs. Share price, $125 a share. Before the crash, $136. Over the, it's not too bad though. Looking at this is what you want to see generally with companies, a fairly stable, steady increase in share price. Not much volatility, just a nice steady increase. And then this time when you get this drop, that's when you buy in. Let's look at the revenue. So revenue has been growing steadily, 8.35% compounded annual growth rate. Operating profit has been increasing 14.3%. Net profit has also been increasing by 24.6%, which is pretty incredible. Earnings per share, operating margin. So yeah, these are all great signs. Dividend has been increasing. So this is also a good thing that you should look for in companies, that they have a reliable dividend, which is increasing. It's a great trait to look for. Revenue forecasted to drop slightly for 2020, given the circumstances, makes sense. Net income, okay, increase in forecasted. So 17 brokers, 4 say hold, 2 buy, 3 strong buy, 1 sell. So overall, that's close to a buy. So you've got people here from JP Morgan, Morgan Stanley, Deutsche Bank, Credit Suisse, all over the world. Current ratio 1.28, still okay, not as good as the other companies we've looked at on this list, but still that's fine. P ratio 21.4, price to book value 20.5, which isn't very good. So yeah, great company overall. Valuation is a little bit high still. Yeah, so looking at the discounted cash flow calculation, it's 59.3% overvalued. That's $125.34 a share. And it says its fair value should be $78. So yeah, a little bit overvalued for me at the moment. I'll keep an eye on the stock though. I'll keep an eye on the company. Financial position analysis, yeah, it's still got a strong balance sheet. So there you go guys. That's my top 6 tech stocks. Many of these are exceptional companies which I've invested in myself. So what are your favourite tech stocks? Let me know in the comments below. Also, if you found this video informative, please smash that like button. That really helps us out with the YouTube algorithm. And with that being said, I'll see you guys next time.
Coming in, Flex, I just wanna win, LABB who we running with, coming in, Flex, I just wanna win,